So hello everybody, and I hope everyone is well. And I want to continue now on chapter 15. So we left off here. I jumped over a couple of examples which I thought you can go over yourself. So we're on section 15.3 now in your book. And basically this is about recapitalizing because you want to basically take advantage of the tax credit. And so let's go over this section here. And it's pretty straightforward. Assume that Midco Industries wants to boost its stock price. Okay, so they want to boost the stock price. That's their goal. They currently have 20 million shares outstanding with a market price of $15 per share and no debt. So that's what, $300 million market cap. All right. So Midco has had consistently stable earnings, and their tax rate, their IRS tax rate, is 21%. They want to borrow $100 million on a permanent basis, all right, forever, and they will use the borrowed funds to repurchase outstanding shares. So basically, they want to buy some shares back, right? So they're going to repurchase outstanding shares with the goal of boosting the stock price, as we said here. Okay, so this is their goal. So this is the means by which they're going to jack up the stock price. Okay. So without leverage, as we just said, right, their market cap is 20 million shares times $15 a share. It's 300 million. Now, if they're going to borrow 100 million, I guess float bonds, and can consistently always have it using permanent debt. I guess it's a perpetuity, right, in debt. The present value of the firm's future tax savings is going to be, right, and here's the tax rate, and here's the 100 million. So they're going to save $21 million a year right, with an interest tax shield. Okay, and this is the present value, right? This goes on forever, right? So this is a perpetuity here, as everyone could see, right? This is a perpetuity. So the total value of the firm now becomes, with the 100 million borrowed, the levered value is the unlevered portion, which we calculated, plus the levered portion, right? Which gives us 321 million. Now the value of the debt is 100 million. Therefore, the equity value is simply 221 million, right? So the levered minus the debt, right? So here's the completely levered value. Here's the debt, right? It's 100 million. So the equity, the value of the equity now is 221 million. So the value of the shares outstanding drops to 221 million, right? So shareholders will also receive the 100 million that Midco will pay out through the share repurchase program. Okay, so you see, even though the share values drops, they've got that 100 million they're going to pay out through the share repurchase. So in total, the shareholders now received a full 321 million, right? A gain of 21 million over the value of their shares without leverage. Okay. So you can see they boosted the stock price by doing a buyback and using that 100 million they borrowed. All right, so assume Midco repurchases now its shares at the current price of $15 a share, right? So let's say they repurchase at 15 a share. So the firm now will repurchase 6.67 million shares, okay? So here's the 100 million that they borrowed, and they're going to basically pay $15 a share, right, to repurchase them. The repurchase, so that's 6.67 million shares. It will then have 13.3 million shares outstanding after they buy 6.67 million back. Remember, they had 20 million, right? So that's going to be the share repurchase there. So the total value of equity is now 221 million. Therefore, the new share price goes up to 16.57 a share. So shareholders who keep their shares earn a capital gain of $1.57 per share, right? You see that? So the total gain to shareholders is $21 million, right? As you can see here. So if the shares are worth $16.57 per share after the repurchase, why would shareholders tender their shares to Midco at $15 a share? That's a good question, right? Why would they do that? If investors could buy shares for $15 immediately before the repurchase and sell these shares immediately afterward at a higher price, this would represent an arbitrage opportunity, right? So that's a problem there, right? So you're not allowed to have arbitrage, right? So you got to prevent arbitrage, right? So realistically, the value of the equity will rise immediately from 300 million to 320 million after the repurchase announcement. So with 20 million shares outstanding, the share price will rise to $16.05 a share. All right, here's the value, the total value after the share announcement, after the repurchase announcement, which now means the price, the realistic price is now $16.05 a share. Okay, and this again has got to prevent arbitrage. So with the repurchase price of $16.05, the shareholders who tender their shares and the shareholders who hold their shares both gain $1.05 per share as a result of the transaction. So you can see the transaction was enough to keep arbitrage opportunities from developing here. So that's the way that went. That's the way that goes. So the benefit of the interest tax shield goes to all 20 million of the original shares outstanding for a total benefit of $21 million, right, which is what we saw already. When securities are fair, and here's the important point. When securities are fairly priced, the original shareholders of a firm capture the full benefit of the interest tax shield from an increase in leverage. So this is a real important concept here. By increasing the leverage, all the shareholders, all the original shareholders, even the ones who sell or don't sell, capture the full benefit of the interest tax shield in the interest of not having an arbitrage possibility. Pricing has got to be done fair. All right, so here's an alternative example which you can go over. Right, so, I'm sorry, this is a textbook example. So here's an alternative repurchase prices. Suppose Midco announces a price at which it will repurchase 100 million worth of its shares. Show that $16.05 is the lowest price it could offer and expect shareholders to tender their shares. How will the benefits be divided if Midco offers more than $16.05 a share? So you can go through all this here. So you can see the important point that's basically said here, that no one's going to tender their shares. So, looking at this table here, and you notice they bold this. This is the share repurchase amount in millions, 6.23 million shares. And here's the share prices. Here's the shares remaining. So they repurchase these. They have that, and that keeps the new share price the same. You notice if we don't do this, we have arbitrage opportunities here. Here's the repurchase price. Here's the new share price. So the important point here is that if Mitco offers a price above 16.05, all existing shareholders will be eager to sell their shares because the shares will have a lower value after the transaction is completed. In this case, Mitco's offer to repurchase shares will be oversubscribed, and Mitco will need to use a lottery or some other rationing mechanism to choose from whom it will repurchase the shares. In that case, more of the benefit of the recap will go to the shareholders who are lucky enough to be selected for the purchase. So basically, you want to keep this here so you don't have any type of arbitrage. And eventually they'll become oversubscribed if it's priced over. And you'll see the new share price will be lower here. All right, so I'll skip over this alternative example. So in the presence of corporate taxes, we must include the interest tax shield as one of the firm's assets, okay? A tax shield is definitely an asset, right? So if we look at this table here, using the interest tax shield as an asset, here was the initial, before we did anything, here was the initial market cap. And we have this interest tax shield that we have here. We recap announced after we borrow 100 million. So here's the total assets. We then issue the debt, right? We then issue the debt. So basically now here's our total assets, right? And basically we have 100 million in cash because we basically borrow, we took in. So this is an asset. But it's 100 million on the liability side also, right? So in fact, here it is right here, right? So anyway, our share repurchase. So this cash goes away, all right, because we basically used it to purchase shares. So here is our basically total assets. Now, on this balance sheet, here's the liability side, right? So here's the debt issuance, right? We have this liability, and we still have this liability, right? So equity is assets minus liability, right? So here is equity. Here's equity. Here's equity, right? Here's the same equity, and then we bought the shares back, and here's our equity portion. So this will give you the shares outstanding, right, in millions, based on the purchase price, right? And here's that again. Here's that purchase price. This was the initial price, and you can see the price is set to prevent any arbitrage opportunities here. So this is a good table to review. So as you know, with regards to dividends, the cash flows are taxed twice, right? Once at the corporate level, and then investors are taxed again when they receive their this should say dividend payment, right? And so interest payments received from debt are taxed as income, all right? So this is for individuals. This is an important consideration, right? This is an important consideration. So even on dividends, on debt, I'm sorry, on debt, on bonds, you're going to be taxed, even though the company isn't, right? Equity investors have to pay taxes on dividends and capital gains, and the corporation, also as you're aware, has to pay taxes on dividends also, right? So the individuals get hit on both sides, basically. All right, I'm going to stop here. I'm about 70 minutes, and this is slide 60. All right, I'm going to stop here, and I'll pick it up on the next part.